Welcome to The Explainer. So X Financial just dropped a record-breaking quarter. So why on earth did the stock absolutely tank? Today, we are going to deconstruct an earnings report that served up some truly stellar numbers, but left the market with a pretty serious case of indigestion. And this, right here, is the central paradox we're unpacking today. The company reports a blowout quarter, the shares pop in the pre-market, and then, boom, the bottom completely falls out by the closing bell. So what in the world gives? Okay, so we're going to tear this thing apart and look at all the conflicting signals. First, we'll dive into the incredible results that really should have sent this stock to the moon. And then we'll get into the real mystery, why the market basically gave it the cold shoulder. And let's be super clear here. The headline numbers were, by any objective measure, fantastic. So let's kick things off with that top-line growth. First up, revenue. It hit an incredible $317.3 million. That's a massive 65.6% jump from the same time last year. And management was quick to point out that this was all driven by just really robust demand from borrowers. And you know, that revenue growth, it was fueled by just sheer raw volume. The company facilitated a record 39 billion RMB in loans. That's a 71.4% increase from last year. It just goes to show their platform isn't just growing, it is scaling at an incredible pace. Of course, all that activity flowed right down to the bottom line. Non-GAAP earnings hit $1.98 per share, that's their ADS, and that's up a staggering 86% year over year. Now, a big piece of that boost came from a really aggressive share buyback program, which, as you know, reduces the number of shares out there and makes each one that's left just a little more profitable. But you know, maybe the best part of this whole story was the asset quality. Their 90 to 180-day delinquency rate, which is a super important measure of loan health, it dropped by a full third. This is the proof that their disciplined approach to underwriting is really paying off. So with numbers this good, what went wrong? Because this is where the story takes a sharp turn. Despite all those stellar numbers, the market just turned its back on the stock. So let's dig into that core mystery. Why did all that early optimism just evaporate so quickly? And wow, this timeline tells the story perfectly. The call starts, the stock rockets up over 6% in pre-market trading. But by the time that closing bell rang, it had done a complete 180, finishing the day down over 4%. I mean, that is a classic and absolutely brutal intraday fade. You see, what happened is that there were two completely different stories at play. On one hand, you had management, and they were rightfully celebrating record originations and great shareholder returns with buybacks and a brand new dividend. But the market was focused on a totally different story. They heard the cautious guidance for next quarter, they saw the stock was already underperforming its peers, and of course, there are always those lingering worries about the regulatory scene in China. And right here, this is the smoking gun. This quote from the CFO Frank Chung during the earnings call is what really spooked investors. When he said they were planning for a deliberate moderation in loan volume to focus on asset quality, the market only heard one thing: the hypergrowth story is over. And even if it's for all the right reasons, the market sold first and asked questions later. Okay, so let's put it all together. What does this all mean for the next quarter? We're going to shift from just analyzing what happened to our forward-looking verdict. So here's our official rating and exactly what we'll be watching for. Our rating on X Financial is market perform. Look, the fundamentals are strong, and the fact that asset quality is improving gives us a cautiously bullish outlook. But that moderated growth guidance, combined with the market's really skeptical reaction, it just means the stock is probably going to trade in line with the sector for a while. So this really sets up what we're calling a prove-it quarter for management. Three things absolutely need to happen. Number one, they have to hit that new lower loan guidance. No excuses. Number two, those delinquency rates have to stay low to prove that this whole pivot to quality was worth it. And third, if they can do both of those things, well, the catalyst is that the market could start to re-rate the stock, rewarding this new, more disciplined approach to growth. So how might you actually trade this? Well, here's one idea: a classic pairs trade. You would go long X Financial, and at the same time, you'd go short the KWEB ETF, which is basically a basket of China internet stocks. The thinking here is pretty simple. X Financial has gotten hammered compared to its peers recently, even though its fundamentals look better. This trade is a bet that that performance gap is going to close, with X Financial outperforming the sector whether the whole market goes up or down. So when you boil it all down, X Financial is asking investors to trade that explosive, maybe risky growth for more disciplined, high-quality growth. The big question for next quarter is, will the market finally reward that discipline, or will it keep punishing the slowdown? As always, this is for informational purposes only. This is not financial advice.